The collapse you were warned about is not some distant movie scene. It is already happening, and the people who profit from it want you to keep calling it temporary. You think you are losing money in a market crash, but most of the time you are just transferring it quietly to someone else's balance sheet. And here is the part nobody wants to say out loud. The worst part is not that prices fall. The worst part is that the system needs you broke to keep working. This is not financial advice, this is financial education, and it is meant to be uncomfortable because 2026 has made comfort expensive. In the last few years, you have watched jobs get automated, wages get stretched, and housing prices detach from reality. You have watched inflation come down on paper, while your weekly grocery bill still feels like a personal punishment. You have watched the stock market climb like nothing is wrong, while you are one emergency away from using credit cards you swore you would never touch again. And now, when volatility returns, you are told to stay calm, diversify, buy the dip, and trust long-term fundamentals, as if the foundations were not quietly rewritten behind your back. So today, you are going to hear a hard framework for what is really going on when markets break. You will learn why the bottom is a marketing fantasy, why massive money flows do not vanish, why the Fed and governments can create the conditions for asset transfers, and why 2026's AI-driven labor shakeup and housing crisis are not separate problems. They are one system doing one job in different costumes. Let me start with a scene you have probably seen already, even if you hate watching it. Picture a 32-year-old nurse named David. He works nights because his shift pays better and because he is trying to keep his head above water. He got into a retirement plan late, then tried catching up when everyone on social media said the market was easy. When prices started wobbling, David told himself he was fine because he had done the math back in 2020. Then came the day his brokerage app showed a sudden drop, and then another. He refreshed, hoping it would bounce. It did not bounce. By the end of the week, he was staring at red numbers that represented months of his life. Now add another layer. David also has a mortgage payment that keeps rising because his property taxes jumped and because insurance costs are climbing in his state. He is not imagining stress. His bills did not wait for markets to settle. So when the market drops, he does not just feel poorer. He is forced to sell something. Maybe stocks, maybe a small investment, maybe anything that can turn into cash before the late fees hit. That is not an individual story. That is a business model, and it connects directly to what you are seeing right now with AI disruption, higher job volatility, and the wealth concentration that keeps accelerating at the top. And here is the cliff you did not want to climb toward. When the market falls fast enough, the losers are not only investors. The losers become forced sellers. Forced sellers create liquidity for the people with cash. And the people with cash do not ask whether you feel ready. This is why buy the dip becomes a cruel joke at the wrong time. In a slow decline, you can wait. In a fast decline, you are not waiting. You are bleeding. The market is built on one brutal truth. When everyone is racing to sell, the cheapest seller is the one who loses last. But the one who loses last still loses. And the one who buys the most during the panic does not lose at all. They are buying on a discount that you are paying for with anxiety, margin calls, and delayed rent. So when you see the price fall, do not ask only how far it can drop. Ask who is doing the selling, who is doing the buying, and where the money is going. Now let's widen the lens to 2026, because this is where the story becomes uglier. In previous cycles, you could pretend that downturns were natural weather events. In 2026, you cannot pretend that anymore, because policymakers and institutions now operate with real-time feedback loops, and AI has sped up decision-making everywhere. Banks can adjust risk exposure faster. Quant funds can identify liquidity traps faster. Market makers can widen spreads faster. And governments can use headlines as triggers because markets have become more sensitive to narrative swings. Even if you ignore all the conspiracy talk, the mechanism is visible. When the Federal Reserve changes interest expectations, when the Treasury auctions get messy, when political leaders announce tariff changes or pause them, markets lurch. And because modern trading is automated, the lurch becomes a stampede. But here is where most people misunderstand what collapse means. Money does not disappear. It gets reallocated. If you watch the headlines, it looks like $6.6 trillion evaporated or global wealth fell. But wealth does not evaporate like smoke. It transfers through price discovery, margin pressure, and forced liquidation. When a stock drops, the investor who bought at a higher level loses. The investor who bought at a lower level wins. That sounds simple until you realize that in crashes, the wins are often structured. The winners may be short sellers, hedge desks, or institutions using leverage and derivatives. And that is where the common investor gets tricked. You think you are losing money because the market is volatile, but in many crashes, you are losing money because you are on the wrong side of liquidity timing. You are the cashless party, showing up to a negotiation with nothing to negotiate with. AI disruption makes this worse because people do not just lose jobs in 2026, they lose predictable cash flow. They lose the ability to ride it out. When incomes are less stable, selling becomes mandatory sooner. The margin of safety collapses faster, so forced selling spreads. Now add the housing reality, because it is the second engine of forced liquidation. In the United States, Canada, the United Kingdom, and Australia, housing prices have detached from wages. People have become perpetual renters or perpetual refinancers, always rolling over obligations. Insurance markets in some regions have become unstable, which means costs rise even when your income does not. And property taxes and mortgage resets hit households like delayed punches. When your housing costs rise, your investment decisions stop being optional. You cannot wait for ideal entry points. You need cash now. That creates the selling pressure that institutional buyers are waiting for. And while you are selling, the top 1% does what it always does. They borrow against assets instead of selling them. They use low-cost leverage when it is available. They structure gains in tax-optimized ways. And during volatile periods, they often have the exact thing you do not: liquidity. In 2026, this liquidity gap is the difference between holding and getting wiped. Let's connect this directly to inflation, because inflation is not only about consumer prices, it is about purchasing power and time. A lot of people hear that inflation has come down and they feel a wave of relief. But purchasing power is not a line that comes back to where it used to be just because a graph looks nicer. If your salary did not rise as fast as prices from 2019 onward, you are still behind. You can see it in rent, food, healthcare, transportation, and in the interest rate you pay on every dollar of debt. Meanwhile, assets behave differently. Stocks and real estate can rise even while the average person suffers. And in a wealth-concentrated economy, that means the asset holders benefit as the cash-strapped get punished. So when markets wobble, the average person is not just losing paper value, they are losing their buffer. They are losing their ability to absorb shocks. That brings us to the second uncomfortable idea. The Fed's interest rate decisions can be painful in two ways. First, higher rates punish borrowing and slow economic growth. They can cool spending and increase default risk. That directly affects jobs, especially in sectors with heavy credit dependency. Second, higher rates influence asset pricing and capital flows. Global money chases yield. If the Fed keeps rates high while other regions suffer, investors tend to allocate more to U.S. assets. When that flow reverses, or when policy risk rises, the unwind is brutal, and it is rarely symmetrical. You might notice that in downturns, the pain hits households first and institutions later. That is not accidental. It is built into how credit works, how leverage works, and how time delays operate. This brings me to the first mechanism that you need to understand if you want to stop being surprised by crashes: leverage liquidation. When markets fall, leverage magnifies the move. Margin accounts can force sales. Derivatives can trigger hedging flows, and institutions can use the same volatility as a weapon. Now, I am not asking you to trust a vague narrative. I am asking you to observe what happens when volatility spikes. Spreads widen, liquidity thins, good news stops working. And you see a pattern. Price drops, then drops accelerate, then the selling becomes self-fulfilling. That is not philosophy, that is plumbing. And in plumbing, the direction of money is everything. In the original version of this argument, the idea is that when governments use policy tools like tariffs, they can create market shocks that force selling, and then insiders buy. Whether you interpret it as coordination or coincidence, the financial outcome is the same. Forced liquidation transfers wealth. Now translate that into 2026 Western reality. In 2026, tariffs and trade restrictions are still tools politicians use because they can appeal to voters and they can reshuffle supply chains fast. But tariffs also change costs. They can raise the price of imported components, disrupt manufacturing timetables, and squeeze margins for companies that cannot raise prices without losing customers. So who gets hurt? Workers, small businesses, families, and who gets to wait for the dust to settle? Capital holders. This is why macro policy is not abstract. It hits your paycheck, your landlord, and your grocery bill through a chain of intermediaries. Here is a micro story that feels too real in 2026. Imagine a small electronics assembler in the Midwest. Their parts come from multiple countries. Suddenly, tariffs raise the cost of key components. They face two ugly choices. Option 1 is to raise prices, but customers cut orders. Option 2 is to keep prices, but their margins vanish. Either way, cash becomes the enemy. Not earnings, not future potential, not brand value, cash. If they cannot manage the cash gap, they delay payroll or they cut headcount. Then those workers stop buying, retail slows, supplier demand falls. And suddenly, a tariff policy turns into layoffs, so the market reaction is not random, It is a delayed translation from policy to cash flow to insolvency risk. And while that happens, public markets can swing violently based on headlines. That is where traders and leveraged desks can move money quickly. But there is a third stage that most viewers never connect. When assets reprice fast, the wealth concentration accelerates. AI companies, platform winners, and data monopolies can keep expanding in down markets if they have capital. Traditional industries that depend on steady labor and stable financing get crushed. Meanwhile, the top 1% can deploy capital to acquire undervalued assets because they can afford to. So even if the government says it is protecting jobs, the system's structural incentives often reward capital during distress. That is why you should be suspicious of any narrative that tells you the crash is fair. Market outcomes are rarely fair. They are systematic. And here is the cliffhanger moment you need to sit with. Remember David the nurse? The day he sold to cover expenses, he sold near the bottom of his personal risk window. He did it because the mortgage payment did not care about his thesis. He was not buying the dip, he was exiting under pressure. Now imagine that at the exact time he sold, institutional buyers were stepping in with cash and shorting strategies hedged against further decline. When the market later bounced for a few days, David felt relief for about 3 minutes. Then rates and unemployment risk continued to rise in the background. That bounce was not the end. It was a liquidation relief rally. So he stayed vulnerable. He kept paying higher costs. And he watched as the next asset bounce went to people who did not need to sell. That is how the rich get richer during crashes, not because they have magical predictions, because they have liquidity and time. Now let's talk about the retirement crisis, because this is the part that makes the darkness feel personal. Many people in 2026 assume their retirement system is stable. It is not stable. Social Security faces long-term financing stress. Pensions in some industries are underfunded. The retirement age keeps getting pushed back, and people who are laid off in their 50s often find that new jobs do not offer comparable benefits. And even when employment returns, it may be through gig work or part-time work that does not rebuild retirement savings. So when markets drop, retirement investors are not just investors, they are near-term spenders. They need their accounts to recover. They cannot wait 10 years because their timeline is already shrinking. That is why retirement volatility is not a theoretical risk, it is a forced selling pipeline. And AI makes this harder because it replaces not only tasks, but also the career ladder that older workers used to rely on. Many people do not get reskilled into stable work. They get underpaid work with less security. Their cash buffer becomes thinner. Their ability to withstand market drops becomes weaker. So when institutions engineer volatility, the ladder of forced selling becomes taller. Now we reach the third mechanism, the cash funnel. Here is what most people never learn in personal finance videos. In a crisis, governments and central banks can choose how to allocate liquidity. They can backstop certain systems, while households get to suffer through adjustment. Sometimes they do it overtly. Sometimes they do it through the structure of asset purchases, lending facilities, and regulatory changes. Sometimes the backstop is indirect, by ensuring that major market functions keep operating. But the result is often the same. The financial system can preserve the capital base for insiders, while households and small businesses absorb the shock. So when people talk about the Fed saving the markets, do not interpret it only as stocks will go up. Interpret it as some actors are protected from insolvency and others are not. And that protection can create asymmetric outcomes. Protected capital buys distressed assets at scale. The unprotected sell at worst prices. This is how you get a cycle where the market appears to recover while average people do not recover. Now, the question you are probably asking is, why would policymakers allow this to happen? The easy answer is that governments are imperfect and markets are complex. The comforting answer is that nobody intended it, but the colder answer is that in many cases, policy incentives reward capital preservation and systemic stability over household fairness. If keeping the financial system running requires transferring risk away from institutions, then the system does that. It is not personal, it is structural, and in 2026, structure matters more than ever because global debt has ballooned beyond $300 trillion. Debt does not stay stable when growth slows. It demands rollovers, it demands confidence. And when confidence breaks, liquidity becomes the only thing that matters. So who has liquidity? Capital holders, major banks, major bond desks, hedge funds with funding lines, and governments with reserve privileges. Who does not? The person whose savings got eaten by inflation. The person whose rent rose, the person whose job got automated, the person whose retirement is not fully funded, the person whose insurance company exits their state. So you should stop asking whether crashes are fair. Start asking whether you are on the side that gets access to liquidity when the storm hits. Now let's address the world's most popular lie in finance education, that the market is a neutral scoreboard for talent. No. The market is a machine that prices risk and liquidity. Talent is a story people tell themselves to avoid the true driver, money and leverage. This is why passive investing looks good on paper but feels terrible in panic. It is not wrong to invest. It is wrong to assume you control the timing of your life. If you are forced to sell during a crash, you break the compounding logic. Compounding needs patience. Panics kill patience. In 2026, social media has added a new layer of illusion. Creators sell the dream of passive income while most of them earn nothing from content. They talk about freedom and wealth building, and they ignore the fact that most viewers are working paycheck to paycheck. They ignore the fact that emergency savings rates are low. They ignore the fact that student debt, medical bills, and housing costs dominate household cash flow. Then the market drops, and those creators vanish behind sponsored affiliate links and brand deals. The dream was always monetized. Your stress was always the audience. So here is understanding, earned the hard way. The market can crash because cash becomes scarce. Cash becomes scarce because interest costs, risk premiums, and policy uncertainty rise. Policy uncertainty can be driven by tariffs, trade actions, election rhetoric, regulatory changes, and geopolitical tensions. In a high-leverage system, uncertainty triggers liquidation, and liquidation transfers